So what exactly is an APR and where does it come from? And how helpful is it in comparing options and making a decision? Well, as you will soon find out in this video, not very helpful, at least in my opinion. The APR, which stands for annual percentage rate, is supposed to represent the total cost of borrowing, and its disclosure is mandated by law in certain situations, including with most advertising. Unfortunately, its use, which was intended to give consumers a good way of comparing apples to apples when choosing from different lending options, is actually quite misleading and can in fact cause people to make the worst choice, not the best, at least with longer term loans like mortgages. The APR is calculated using certain closing costs, which are grouped together into what are called finance charges, and deducting them from the loan amount to come up with more of a net amount you've actually received. Then taking your monthly payments and looking at how much the return is to the investor based on the lower net loan amount and those specific payments over the life of the loan. While some of the APR costs, of course, do make sense, like mortgage insurance, points or lender fees paid, others not so much, like attorney fees, which have nothing to do with the loan and are not controlled by the lender anyway, or prepaid interest, which varies with the date of closing. And if the lender uses an affiliated title company to close the loan, then all of those fees become part of the APR calculation, which inflates the APR compared to a quote using a non-affiliated company, even though you would have essentially the same charges either way. But the main flaw with the APR and its use in terms of comparing mortgage options is the fact that the underlying assumption is that the loan is held for the entire term of, say, 30 years, which is basically unheard of. And it's much more likely to last, say, 5 to 7 years, or maybe a little longer. So if someone paid 2 points on a loan to buy down the rate and spreads the cost of those points out over, say, 6 years instead of 30, obviously the average cost per year goes way up. If the consumer uses just the APR to determine the best option, he or she could end up paying a huge amount of additional closing costs that will never be justified given the much shorter period of time they will actually have the loan. Since once again, these APRs assume you'll have 30 years of savings at the lower rate to profit from that higher upfront cost versus the much shorter period in reality. My advice is to basically ignore APRs when it comes to comparing mortgage loans, at least. Although they are helpful in comparing much shorter loans that you'll see, like car loans, personal loans, cases where you're likely to keep the loan for the entire period of time. With mortgage loans, though, you really want to look at the underlying components of rate, lender fees, and points, and line up apples to apples options with no points, 1 point, etc. Then you can run break-even periods to see if the points are justified. And keep in mind, too, as I've referenced in another video about paying points specifically, it's not just about the break-even on paper. It's also about human nature and whether you would really be able to set aside and reinvest that relatively small additional monthly savings from a lower rate. Oftentimes, it's better to just leave that money alone and invest it elsewhere for the longer term, even if the APR is technically slightly higher. So I hope this video has been helpful, and as always, please feel free to reach out to me anytime I can be of service. Thanks, and have a great day.